Good morning. Today is Wednesday, July 19th, 2023. This is the Arlington County Equalization hearing. There's a quorum of 5 members present. Excuse me. There's a quorum with 6 members present. There are 3 cases on the agenda. The first case is RPC 1403502G. Property located at 671 North Glebe Road. We have Mr. Sean Benstrom here for the appellant, and you can start with your 8 minutes and tell us about this property, sir.
Hi, good morning. Well, I know this is the 4th time I've presented in front of this board. As a reminder, I'm a principal at a boutique property tax consulting and valuation firm specializing in regional shopping malls throughout the United States. Subject property is Ballston Quarter Mall, approximately 357,000 square feet, anchored by a Macy's, which is unowned and not part of this appeal. If the board could turn to page 65 of the BOE memo or page 1 of our analysis, I'd like to start there. The subject property, the January 1st, 2023 valuation from the assessor is $90,062,600 versus the 2022 board found value of $86,744,000. As indicated on the page, our opinion of value and ownership's opinion of value is significantly less and supported by a very thorough and detailed analysis within this package. And unfortunately, the mall is still only 76% occupied, going on 4 years post redevelopment. If you could move to page 76 of the BOE memo or page 12 of our analysis. Some of the highlights for the January 1st, 2023 valuation date is the announced Macy's closure in December of 2022. Macy's was fortunate enough to obtain entitlements to build residential and will be closing the Macy's store. And this will have a financial impact on the subject property. Macy's does contribute a portion to CAM reimbursements. And also there's tenants listed there on the page in which they have co-tenancy clauses in place, which will financially impact the subject property. Further down the page, the entertainment tenant that has emerged from bankruptcy was previously paying an 8% percentage rent in lieu. They have gone back to a full pre-COVID rent. However, we've provided documentation that this rent is not indicative of market, and at that rent level, it's an 18% occupancy cost, which is unsustainable. So any investor valuing this as of January 1st, 2023 would most definitely discount that rent for that major tenant. We move on to the next page, 77 or page 13 of my analysis. This is very highly publicized, the Regal Cinemas bankruptcy. Again, significant risk to the income stream associated to our subject property here, as the Regal represents just under 19% of total GLA of the mall. And then at the bottom of page 77 of the BOE memo, the impact of the return to office, or decline of really the return to office. So the Castleback to work barometer that was provided to the assessor's office for February of 2023 still shows the DC metro area as below 50%. And I have watched a few of these hearings recently, and I understand the adjacent office building is 36% vacant, with E-Trade out at the market looking to sublease their entire all their suites there at the property, at the office building adjacent. So this is clearly having a material impact on the leasing velocity at the subject property, as well as sales of the tenants there. We can move to page 84, please, of the BOE memo. This is really the crux of the case. Here's our NOI trend going back to 2018. And as we're entitled to do here, it's January 1st, 2023. I understand it's an annual valuation, and in watching many of these hearings, that's constantly reinforced. And I think the big issue here is the assessor's stabilized NOI of 9.72 million. Here I am 4 years later, 4 lien dates later, we're nowhere near that. And that's really the huge crux of this case. We provided significant information, answered, I believe, 16 very detailed questions to Lori and the team. And ownership, I hope it comes to $9.72 million at some point in the future, but we're here now, 4 years past, nowhere close to that. And I don't believe any reasonable investor at January 1st, 2023 would assume that or capitalize that as a stabilized income. We can move to page 87. One of our differences, and one of the differences this year, is the assessor has increased the major rent category, about 80,000 square feet, from $17.50 last year to $27 this year. As you can see, that entertainment tenant did just emerge from bankruptcy and previously was paying 8%, which is really the occupancy cost that's sustainable for that tenant, which was approximately $7.77 last year. And then the non-traditional retail tenant listed at the top portion of that page is paying $13.82 plus $6.18 in tax contribution. So on that page, you can see our conclusion of fair market value rents as of the January 1st, 2023 lien date. Page 88. This again summarizes NOI and operating expenses as of year-end 2022. Page 91. Speaking of capitalization rates, Green Street Advisors reports independent capitalization rates for every mall throughout the United States. Green Street reports Boston Quarter as an 11% capitalization rate as of January 29th, 2023, right at our lien date. Page 93 of the BOE memo. This is a Cushman and Wakefield mall grading matrix, which indicates capitalization rates from a B to B plus mall, anywhere from 8.5 to 15%. And we concluded, in our opinion, a very conservative 10.2% capitalization rate. If we could go to page 96 quickly, that's our cost to reach stabilization as the property is still suffering from very significant vacancy. And finally, on page 97, on the left-hand side, is our direct capitalization. And if you just have my analysis, it's page 33. The left-hand side is our direct capitalization, where we conclude at our market rents, market expenses, and you can see our stabilized NOI is significantly higher than what they've actually been achieving, but is significantly less than the assessor's opinion of stabilized NOI. Apply our capitalization rate to get to our valuation. And I do request that the board provide our valuation as of the January 1st, 2023 lien date. Thank you.
Thank you. Ms. Ross, Kensington County, please.
Thank you, board members. Thank you, Sean, for being here today. So first of all, I wanted to refer you to the summary page, which I believe is on page 5. Yes, page 5. This is where I'm primarily going to be speaking from. So the agent has submitted, first of all, they have submitted income and expense statements, and I wanted to explain here that for years 2020 through 2022, they have submitted income and expense statements, and they're reporting actuals. So what I had to do was to reconstruct their rent roll and their income statements that they did attach to each I&E. I had to reconstruct those, and this is what I'm going off of. This is how we came up with our test column. So when we're looking at the base rent, I took into account that they are still having some problems with abatements and deferrals. I also took into account some of the rents that are still being paid in percentage of lieu of base rent. However, a couple of those tenants who are paying percentage rent in lieu of base rent, it's actually like they're still paying a partial base rent, but it's drastically reduced, and then the rest is being paid by the tenants based on the tenant's sales. So I took all of that into account when in test column F, I took all of that into account when I came up with the base rent. I also, if you note, for the percentage rent on the test column, please note that I used something less than what they're reporting. Okay, that percentage rent, as I said, some of the tenants are paying both base and their percentage rent. And when I looked at it, it was basically equal to what they should have been paying if they were paying their full base rent. So that went into consideration on the base rent on the test column F, and I just did not include that percentage rent in test column F. The amount that you see there is for people or for tenants that it's in their contract where they're paying base rent, and anything they are paying their full base rent, or anything over based on their sales. Also, the other adjustment was the pass-through. I reconstructed the pass-through, and we did use our standard 10% stabilized vacancy. Yes, the client is experiencing, the owner is experiencing about, I think it was roughly 24-25% vacancy right now. And that was accounted for below the line adjustments. And with this particular property, the reason why we incorporated below the line adjustment is because they are still leasing up new space. And I did want to point out there was a shuffle in square footage, net leasable area. I discovered that in the past on their rent roll, they were reporting office space as retail, when in fact it's really office space. It's about 27,000 square feet. It's the location of it is the second floor of the Origin apartment building. Okay, so on the first floor is retail, which is considered in this valuation. The second floor is fresh new office space, which is considered in this valuation, along with the base, the core building, which includes the theater and all the other shops that are surrounding it. As for, let's see, the expenses, when I reconstructed the expenses, if you'll note that I used something higher than what we used for the January 1 assessment. After considering, if you'll see on the comments, I put notes 1, 2, and 3. I want to reiterate note 3. I discounted the theater rent for deferment, deferred rent. I drastically reduced their rent. Okay. For the inline retail tenants, I discounted their rent for latent COVID related abatements. I discounted the percentage rent. And I also excluded a very small termination fee. I excluded that from column F. And then on top of it, I did below the line adjustments. So I gave a great deal of thought and consideration to all the issues that this particular property is having. And that was the result of column F. If you have any other questions, if you have questions, I'm open for that. Thank you.
All right, thank you both. Questions from board members? Mr. Lawson.
Yeah, what cap rate are you using for Pentagon City Mall?
Pentagon Cinema, oh gosh, I would need to look that up. I think it's something less than what we're using here, if you can give me a moment.
Okay.
All notes, okay. National Union, for, well, I call it Fashion Center Mall, 8.15. Did you hear me?
Yes, thank you.
Yeah,
Yes.
Okay, okay, all right.
I have a couple for the department. No order of preference. In column, thank you for taking away my first question. I understand why these column E2, C2 exist, and so forth. In column E2, make sure I understand this. Under vacancy and collection, rent loss, rent concession, there are three numbers. Those three add up to the fourth number, 5 million plus, right?
Mm-hmm, yes.
So you have this number and you have you assign a percentage to it. And that's your work. You dug into their incomplete submission and you sweated and added and subtracted and came up with a reasonable, a number that you're comfortable with. So when you
Yes.
went to the test, how come you didn't use any number, anything close to that? There's only a quarter to that amount or less.
So once again, what we do is I used a stabilized vacancy rate of 10%. And I recognize, okay, that's stable, they're experiencing something more than the stabilized vacancy rate. So I have a couple of tools, if you will, that I can use. And one of them is to reduce that base rent, which I did. And that's stated in note number 3 in the comments. And then the other tool that I have is below the line adjustments. And
Yeah.
so that's how I accounted for that excess vacancy.
Okay, great. So that leads me to my second question. On TIs for both columns D and F. Why such, and I think I know the answer, but then I have a reclament to that. Why is such a significant difference in the square footage that you're applying your $115 a square foot to, again, in D and F?
Well, D, I was estimating, we didn't have we didn't have the 2022 rent roll for column D at the time. But for column F, we do.
So based on what your analysis from E2, you found out what the real vacancy is. So, and on column D, the vacancy was based on, I guess, prior years.
Yes, and we'll research publications or the CoStar, to see if anything is coming online, and we can always visit the site too.
So it appears that during 2022, they did well. I mean, their vacancy rate went down relative to its prior years, pretty much. It surprises me. Again, what you intuited based on the best facts you could get, in late 2022, it's actually much lower than that when you got better facts from their submission for 2023. So they're doing better than I would have guessed. Okay, great. Last one is, do you add on this cap rate? Does that include the bid?
Yes.
Improvement district that's on there?
Yes, it does. And that is broken out on the prior page. Page 4. I think it's on page 4 where I break it out. And yes, the cap rate is 9.15 plus 0.045. Our CAMA system does not like the third digit. Okay, so it went to 9.2.
And I have one last question. You're in column F. I just don't. I guess maybe you could just check me on this. There vacancy rate based on their I&E for 2023 showed a lower vacancy than you had thought. And so your pass-throughs in your test column went up significantly to account for that lowered vacancy rate. More tenants passing through additional rent, I guess. It just seems like, okay, thanks a lot. I took too much.
Yes.
Other questions? No? Okay, Mr. Lawson.
Yeah, for the applicant, you have less vacancy, but haven't you reduced rents for tenants to accomplish that less vacancy?
Absolutely. As you can see by the non-traditional tenant that I mentioned earlier, taking up a significant portion of the major space at essentially a $20 gross rent. And I think that's where, Lori and I and the team had some, interesting discussions on this, but that's again, one of the large disconnects. Yes, they've been able to achieve some more tenancy in here, but unfortunately at reduced rents, and that's where the disconnect, and that's where I'm having the disconnect, is the 9.7 million is just so far from where the property is at 76% occupancy. So clearly there's some big disconnect there. And yes, the rents they're achieving are not pre-COVID rents.
How much is the church pay?
Yeah, that's the non-traditional retailer I was talking about. I know this is a very public forum. It's $13 plus 13 and change plus $6 towards tax.
Okay.
That's it, Madam Chair. No? Okay, Ms. Ross. Oh, wait.
One last question.
Mr.
For
Metz.
the department, do you agree that it's only 76% occupied, this building, this project?
Yes.
You agree? Okay. Then your numbers are based on that. Okay, great. Thank you.
Okay, Ms. Roskin, if you take a minute to wrap up, please.
Sure. So as Mr. Venstrom is pointing out, there are some non-typical rents in here. I referred you, I'd like you, when you go amongst your discussion, you can refer back to the rent roll analysis. I took those lower rents into account. They are factored in here. I did an analysis to determine what the average rent is for each one of those brackets, the food court, the restaurant, the retail, what's now considered the office space and is actually potentially rented. Okay, and that's for next year's consideration. The major tenants, the storage, all that was broken out in the rent roll, and that's how I developed and came up with the base rent for this property. And once again, I reduced that base rent due to deferments, abatements, and also I gave below the line adjustments to account for the excessive stabilized vacancy. And so, like I said, test column or F is the test. We're asking you to go with the original assessment of January 1 at the reduced value of, at the modified value of 90,062,600 rounded. Thank you.
Thank you. Mr. Venstrom, if you take a minute to wrap up, sir.
Thank you. And unfortunately, I just don't believe those rents are discounted enough. And I think it proves itself in looking at the history, the operating income and expense history at the subject property. We're now 76% occupied and nowhere near 9.7 million stabilized NOI. The proposed, I believe it's going to be medical office. I mean, it just goes to show they had to go to the city and change the use of 27,000 square feet of this in an attempt to lease it because there is no retail demand for this type of center. There is extreme risk associated with this income stream. And one of the board members did ask about the pass-through, and I do believe that 4.5 million in the test worksheet includes 100% of the pass-through, which does include a property tax reimbursement component to that. So yet again, another part of our disconnect. So finally, the subject property is still struggling. There's still significant risk associated with this property as of the January 1st, 2023 lien date. I think we provided significant information to you and to the assessor's office to support this. Thank you.
Thank you both. Okay, it's just among the board members. I have no doubt that Roskin did a lot of deductions and whatnot, but I think in the test, so overstated. I mean, there is no way this property could get 9. What do folks have to say?
Yeah, let me share my thoughts. I think Lori did a great job in the, seeing the trees, if I could say that. The problem is that this forest used to be one combined deal. And they're gonna lose Macy's very soon because everybody is in a stampede to go for residential. And, and I'm no expert at retail, but I know in retail you want retail to feed off each other. So, you come into Macy's and like, hey, I'll catch a movie, I'll stop by the store. But these guys are so desperate to fill this thing up that they're leasing to a church. And the church, I don't think, even has services when half those stores are open. I go over there and I see that my favorite oyster bar is gone. And it seems like this thing's just really struggling. And so what I've been convinced of is looking at Lori's assessment, column D, I think her figures are good, but I think, Lori, and this is no disrespect to the job you do, I think her cap rate is wrong. And I think given the fact that they're losing Macy's and that's going to have a domino effect, and this thing that used to be one big cohesive thing is now broken up. I took the applicant's cap, and if you put it on column D, I'm at 83,788. If you put it on column F, I'm at 87,651. That's kind of my thinking, Madam Chair. I'll see if anyone agrees.
Okay, other folks?
Yeah,
Mr. Hoffman?
I'm right around last year's number, which is in between the dead farms. So, I thought the jump to 9.7 million in NOI was too much, given that last year was under 7. The appellant's got 7, just over 7 projected for next year. I figured we'd take that and use the county's cap rate for Pentagon City Mall, and I got 86 million or 700.
You lowered the cap.
Oh, you lowered the cap, that's interesting.
I did, yeah. Because it's on in place, and I'm not taking any below the line deductions after that.
Oh, I got you.
Just on in place.
What'd you come up with, Greg?
86, 464, 700.
Yeah, I took the appellant's NOI and just used the 9.2. 76.
76, that was the first one I did, and I thought it might be too low.
Yeah.
Yeah, that shows near bankruptcy.
And the malls are unique in the guidelines because there's like a different cap rate for Costco. There's a different, it's like, that's really not what cap rates are supposed to be, is a different one for every single property, the way the county uses it. So it's a lot, I think it's more, I wouldn't want to do that for apartments. I wouldn't want to do that for, hotels, but when we're just looking at one mall versus another, and there's over 100 basis point difference, I think they should be using the same cap rate. At least those 2 malls.
You don't think that, I like that, except this mall's so much shakier than Fashion Center.
Yeah,
They're not the same.
but I mean, the difference is in the lease up potential. Is Pentagon City could be at 95% and it trades at an 8 cap, right? Boston Quarter's at 76% and it trades at an 8 cap, but you've got the ability to grow the income. So
And in there, the architect should be strung up.
I thought it was a terrible design.
yeah. I mean, my first inclination was to do exactly what Mary did at the same number. I just felt like that was probably too.
Yeah, too low.
Yeah.
You feel comfortable with not taking, just for straight, narrow consistency, the way we do things and the way the department does things, to take the below the line, just tinker with it, but keep the below the line elements because
No, he's
they're
not
legitimate.
keeping up.
No, I'm
not.
saying, I know that he's not.
Yeah.
That's why I'm bringing it up. I'll say it differently. I don't feel comfortable with doing that because these are legitimate below the line reductions that all agree on, including me. That doesn't mean that I wouldn't like to tinker with some other number in here. Because I don't think that the value of this place went up from last year.
Yeah, and I'm right at last year's number essentially. We could also just say it hasn't improved.
No, I think it's worse.
Yeah.
Yeah, I think it's worse.
Yeah, and
And then you got
and let's not get into Regal and Macy's. We all know that's true, but we're on New Year's Eve, 2023, so that hasn't happened yet. It'll sure happen next year, for all the reasons everybody's brought up, most likely. It's, intervention from higher being.
But an investor looks at
I know, but not investors.
it.
That's the market.
Nor do we play any on
Okay,
Zoom.
just to throw one other
Teams.
number out there. That's what I was saying. If you take Greg's 80, take the 7 million below the line adjustment. From the standpoint of
Sure.
being equalized.
Sure.
with our people.
So that's a 10% reduction in value.
I think it's happened.
Yeah.
I think.
You do?
This is a.
Honestly, too. I'm over there every other.
But they're, I know it's discounted, but their vacancy rate has reduced notably. Again, they're not,
With the weird.
With give up.
Right,
With a
with
term.
tons of concessions and lower.
no,
rents.
I know, at lower income, but they are doing what they're supposed to do. And we're talking intuitions here.
Awkward.
And market would look at Macy's change
Oh,
going
yeah.
on there. So it's definitely, it is down. There's no way the market value or assessed value should be up.
No, I don't think it should be up.
What, it should be lower than last year?
You have 10% lower, that's a difference.
Because I think the value is, and Macy's is not in there yet, but there's an impact here. And they've given a lot of concessions and things to get to where it is. It's not going to get better.
Well, put up, it's gonna be 280 units in place of Macy's. I know that's 3
Down.
years from now.
Yeah.
Right.
3 years from now, but Macy's isn't this year either, their demise, although it's a ghost town in there because of nothing to sell.
And what's left, are they gonna be with Macy's out of there? Or what's gonna happen to everyone else? I mean, I know that's the future.
Macy's.
I was just making the point that we're continuing talking about the future.
It's-
I'll talk about the future's future, I mean,
But that's
where
where the
does it stop?
value is.
Yeah.
No one's looking at,
Go ahead.
yeah, no one's looking at just today's value based on numbers today. They're looking at where's this thing going? And that's my concern.
And also Macy's, when I quit shopping at that Macy's because there's nothing
No,
in
there's
there.
nothing in there. I know that. The impact's already occurred.
I mean, I could walk to it, in 2 minutes.
Well, Regal too, no,
You could buy the Sheldon.
Which is why I don't think that the value should go up. But going down 10% makes me uncomfortable.
Well, I thought the first approach. Was lower than that. It's just-
Yes, maybe I gummed up the works by talking about below the line and just
I mean,
accept.
it's okay.
Yeah.
That's what we're.
Mark, where
All three numbers are about the same. I definitely think it's gotta go down. Which option? They're all about the same.
If you could do 78.8, that might be
They're all-
said,
that's-
and I think that's 4 of them.
are you okay with that?
Yeah.
Because if not, I don't want it to default back
All right.
to 90 million.
Yeah, no,
Yeah.
yeah, that's kind of where the numbers should be.
All right, then I'm going to move to reduce the assessment to 78,804,600. That's based on taking the appellant's NOI, using the Pentagon City cap rate and the 7,000 660,100 below the line adjustments.
A second.
Okay, motion and second by Mr. Lawson, all in favor? Aye. Opposed? It's 4-2, and that's without Ms. Maskin. And Mr. Penarond. The assessments reduced to 78,804,600. Thank you both.
Thank you.
Hold on 1 second, I'm just trying to get my notes, so when somebody asks me about this next week, I know exactly what it
Next week, for me, it would be tomorrow.
Yeah.
is. The minutes, that's. Okay, all right,
I know.
moving along to the next, we have Mr. Warren, oh, there we go, and Mr. Chekas. Okay, the next RPC is 3201903A at 1301 South Scott. Mr. Warren, you can start with your 8 minutes and tell us about this property.
Okay, can everyone hear me all right?
Yes, sir.
Nice to see everyone again. Hello to Chris. I'd like to direct the board's attention to page 59 of 169, which again just kind of shows our summary of facts for this case. This is the Trove Apartments located at 1201 South Ross Street. It is comprised of 3 tax RPCs. The current assessment for 2023, and we have listed here 123,621,900. That and it's in the assessor's notes here, and I'm sure Chris will state this as well. That was what was listed on the website, so that was a mistake. The worksheet does indicate a current assessment value of 126,309,300, and the value we're requesting from the board today is 114,366,700. This property was built in 2020. It's 401 total units. It is a mid-rise apartment in South Arlington, 6 stories, sitting on 8.28 acres. The property is located south of Columbia Pike near the South Washington Boulevard and I-395 interchange in South Arlington. It offers a mix of studio, 1, 2, and 3 bedroom units and on-site amenities such as a business center, fitness center, laundry facilities, playground, and roof terrace. I'll now direct the board's attention to, I believe, page 3, which is the county's apartment income and expense survey for this building. You'll see that there's not a lot of historical data for this property, being it was built in 2020, an unfortunate time for it to come online. It came online right during COVID, and subsequently has had problems leasing up since that time. You'll see in 2020, it had a vacancy of almost 83%, and 34% the following year in 2021. And after a very aggressive concession package that was offered, they were able to finally lease the property up and reported 5% vacancy in 2022. Now, in order to do that, you'll see in column E that they reported a total of $978,455 in rent concessions. Again, it's a very aggressive package that they offered to new tenants to finally get this building that was originally built in 2020 leased up. You'll see in column D the EGI of the county in their original assessment of $10,265,958 is pretty closely aligned with the actual operations of $10,395,399. Now in the column, the county's test column in column F, you'll see that it increased substantially to $11,344,315, and essentially not taking into consideration any of those leasing concessions that it took to get the property to market levels of occupancy. So they're using the 6% stabilized vacancy, and then the full potential gross income, not including any of those rental concessions, again, that it took to get this property up to market occupancy. That's basically the crux of this case. You'll see that the EGIs were pretty similar in the original. the actual NOI in the original column, test column D, is approximately $301,000 higher than what was actually reported in 2022. In the test column, column F, it actually increased to now $800,000 higher than what was actually reported in 2022. So again, it would appear that what we're asking for is the county to consider the cost associated or the concessions that were involved in, again, getting this property to stabilization. In column F, if you're going to not take the concessions, then this property is not going to be 6% vacant or stabilized vacancy, 5% vacancy. It's going to be closer to where it was at 34% as it was last year. So that's what we're asking for is either consideration to the vacancy or the concessions that it took to get this property back up to stabilized levels of occupancy as of 1/1. In addition to that, and the last thing I'll say is with regard to the capitalization rate, the county is currently applying a fully loaded cap rate of 5.4% in their analysis, which would calculate to a base cap rate of just 4.17. That's a 1.03% tax rate and a 0.2% for replacement reserves that are loaded into it to get to that 5.4%. And, I know the board, and I remember the board talking about this in some of the late hearings last year, but inflation is at a 40-year high. It increased 6.4% in 2022. The Federal Reserve increased interest rates almost 5 full percentage points from 0.5% on March 17th in 2022 to 4.75% most recently in January of 2023. And the county's cap rates are derived using an in-house methodology and remain unchanged for the 2023 assessment, even given these challenges that are being experienced in the capital markets currently. The failure to adjust these cap rates, we don't believe is market derived. And as you'll see on page 61 of 169, we've supplied some published cap rates from investor surveys from RERC, showing the difference between the fourth quarter of 2021 and fourth quarter of 2022 for first and second tier properties, experienced an average increase of 30 basis points from 2021 to the end of 2022. PwC over the first quarter of 2022 and 2023 experienced on average an increase of 63 basis points to cap rates for apartments. So in our analysis, we are using a 30 basis point increase to the cap rate that's being applied by the county at 5.7%, which we believe, again, with given the current state of the capital markets, is more than justified. Again, this is it's a newer property, but it's not it's a property that's in South Arlington. It doesn't have access to the metro. It's not a high rise that sits on top of the metro in that Ballston Roslyn corridor. So again, I think the cap rate that's currently being applied is not giving any consideration to the state of these markets, and we hope the board considers that as well. So with that, that's all I'll have, and I'll give it up to Chris. Thank you for your time.
Mr. Chikas for the county, please.
Yes, ma'am. Good morning, board members. Good morning, Mr. Warren. Focusing primarily upon the summary sheet, as the counties want to do. We're looking at a property that's essentially stabilized itself within 3 years of opening. As you can see in the comment field, the property is at 97% occupied. The board has heard this many times before, more last year than this year, as we haven't had too many apartment cases. Concessions are just that. They're a stopgap. They're used to fill occupancy, and they worked. The property did spend that money. They went from 5% occupancy down to, 5% vacancy down to 3% vacancy. They tend to be a stop measure gap. That's what we've seen historically. You can see they didn't spend any in 2021. They did want to continue their lease up. They spent that money in 2022. We would anticipate that very little being spent in this year to continue to achieve that 97%. We've heard that adage before. Once they're there, it's much easier to keep them in-house. And then, of course, you increase rents. If you look at column E, you'll see they did just that. They increased rental revenues by 3%, overall revenues by 6.5%, effective gross by over 63%. Again, as the board is familiar, but we'll remind them, our projections made in column D were well ahead of what we received regarding the year 2022. Once we did receive that information, as Mr. Warren noted, we noted we were over $1 million shy of what was achieved for total revenue, approximately $130,000 lower than what was achieved for effective gross. And while we were lower than what was achieved as far as the OpEx, we did note, and as you've seen before, you start to make some of those adjustments and you can see that essentially you'd be confirming what we already had. We tested the rent roll, as you can see in the page, let me see where the revision is. The rent roll starts on page 71 of 111, that's from the owner. And you can see that when we tested those on page 5 of 169, you can actually see that we depressed the rents that are in place by over 2%. Again, a very modest increase projection of 0.75%, so less than 1% growth. It's fourth year in existence at 97% occupancy. Again, a projection of 0.8% total revenue after 7% in 2022. We would argue that we do in fact account for concessions and rent loss because again, if you note that the property is at 97% occupied, we're using 6% vacancy and concessions. Take 3% to account for the vacancy, that still leaves 3% to account for rent loss and or rent concessions. That would be more than what was achieved at the property in 2020, its first year. They incurred 2% of rent as percentage of total revenue. So we do believe that given that they're 97% occupied, that we are in fact covering any other potential adjustments for rent loss and or concession. You can see in our test, we did grow the operating expense an additional 4% on top of what was achieved last year. Again, assuming that at 97% occupied, there's probably not going to be too much difference in the operating expense year over year. And again, with that very modest 0.82% revenue growth, that did call for an increase to the original assessment. Therefore, we do recommend the original. I would also point out when you look at last year's assessment, this called for an increase of 2.2% year over year, 2.2%. The appellants are calling for a negative 7.5%, a decrease in value. Again, a third year in existence, 97% occupied, well amenitized. They did, what most property owners would hope to succeed, which is stabilization within 3 years of opening and during COVID at that. Given that we believe we did account for the concessions at the property, given that we tested the new information provided by the owner post data valuation, given that that information indicated that we actually were under projecting what is being currently achieved at the property, we do believe that the original value of $126,309,300 should be confirmed. Thank you.
Thank you. Questions from board members? Mr. Lawson.
Yeah, I have a quick one for the applicant. Chris made the point that once a tenant's in there, they tend to stay. Do you happen to know your turnover rate?
It's such a new property. I don't have data on that for this location currently. My understanding is that they are still offering concession packages though. It's unforeseen as to how long that will continue or if that will continue. But it's kind of been the state of the market, especially since COVID is, what you saw is in 2020 when COVID hit, everyone kind of stayed indoors. No one really left. And that's why you saw a huge vacancy at the property. And then in 2021, 2022, you saw people starting to move around from building to building, and these apartment buildings really be aggressive in their concession packages. So it's kind of been part of the market here, and I think we would expect it to continue.
Any other questions?
I have an easy little one.
Okay, Mr.
For the
Metzger.
Department. Chris, down below in every column except for A, where there's nothing, under total operating expenses is a small 4-digit number. What is that for?
That's representative of the operating expense per unit.
Okay. I have a comment. I'm good, thank you.
Okay, all right, Mr. Chikas, have you take a minute to wrap up, please?
Yes, ma'am. Again, most owners dream stabilizing the property within 3 years. Again, virtually the only new mid-rise and or high-rise within that suburban area of Columbia Pike neighborhood. You can see again the initial projections made by the county under projected income by over $1 million. Under projected effective gross. While again, we've under projected operating expense, as you can see in our test, even when we modestly project forward the potential growth that's being historically achieved now, you can see that it still would call for confirmation of our original, which again is a very modest 2.2% increase over last year. Year of growth, NOI growth of 122%. We would ask the board to confirm the original 126,309,300. Thank you.
Hey, Mr. Warren, if you take a minute to wrap up, sir.
Yes, again, as I've already repeated, this property has been in lease up, aggressive lease up since 2020, trying to get this property leased up to market levels of occupancy. The county has, for new properties, given deductions for lease up to for some of these newer properties, noticing and considering the fact that they are in lease up and there are increased costs that are associated with leasing it up initially after construction. This property, again, for reasons already noted, just had an extended lease up period, and we would at least ask the board that the county consider those lease up costs or those concession costs, even if it's below the line. We took them above the line, but there's other jurisdictions I know, like Alexandria. This is a perfect example where they would just take the actual concessions and deduct it right below the line. So again, I think yes, as of the lien date, it was leased up, but we just want the board to consider the fact that there were costs incurred or concessions given to get this property up to stabilization.
Thank you.
Thank you.
It's system on the board. I look at this and think, I prefer the county not run the test. That's ludicrous. Without having the 2023 or 2022 information, I think the original assessment was pretty close. The only thing I would look at, expenses slightly on that. To run the test and say, oh, well, we took a look at this at 7.3 million, and then just say, oh, but we recommend sticking with the original. I think there's absolutely zero value in the test.
I'm okay with the 26, 309, 309.
I would say two little things. One is that I think the department did address the only real note I had to myself about no concessions. Well, we kind of added on more vacancy and it kind of works out. We can't get it down to the, to the dollar. So I'm happy with that. But you mentioned the operating expenses. I don't know, now that I'm thinking about it, maybe in his wrap up, the appellant, what I was going to say was, no, operating expenses had to go up from last year to this year, and column E shows a little bit higher than the original assessment. And that seems reasonable. They did go up a little bit, and I would kind of like to use that figure in column E.
The expense.
Expense only. Having said that, the appellant said, well, there's extra costs in leasing up, and we have extra expenses and blah, blah, blah. And maybe 2022 was a blip, and the column D expenses then might be on target, by the end of the year. So, woulda, shoulda, coulda. So I'm pleased with what, and would support what is originally assessed. And it's also within the range percentage-wise of what we're seeing in fairly good apartment buildings around the county.
I do the same, I looked at expenses and I thought maybe there may be a little room for that, but I think so close that increase from last year to this year significant to the percentages, so I'm okay with it. Original assessment.
Yeah, I tinkered around, but it seemed like whatever I tinkered with, I ended up right at where the assessment is, so.
What do you think about increasing those expenses? Back to the along the lines. 22 was.
Well,
I
again,
didn't even go that high. I went,
just
just to give you an idea, 35%.
percent.
As it comes out of
Excuse me.
123.
572.
Oh, you got that? No, and then I went to 36% just to kind of do a little test. At 121, 67.
I did the same at 35, and I think it's pretty much a little bit lower than last year.
Right, and in fairness to last year, I mean, it's lower, they didn't come, they withdrew.
Yeah.
We might have done something last year, so just say, oh, it went down from last year, we didn't hear.
So-
I mean, to me, I don't know, I look at the 36, which is kind of somewhere in between 3.695. Not quite, they hit at the 3.8, more than the 3.4.
I did both, 35 and 35 and a half. Not 36.
I think the expenses, there's a minor adjustment there, because I think that they're probably off. Other than that.
Yeah, it was spot on.
Yeah, and Ken, and what you saying, and I wrote that down too earlier, they're still gonna give some concessions. I think going forward, but not much.
Yeah.
I mean, they've accomplished their goal.
Yeah.
But they gotta maintain that now. And I think the expense is the only thing that I saw an adjustment.
During 2022, isn't that, I mean, it didn't start off at the low occupancy, didn't it? Didn't it achieve its low occupancy during the year? Am I right or wrong on that?
I didn't see anything. I didn't find anything.
At least enough.
Yeah, because it was 34 vacancy in 2021, 5% 2022. On January 1, it was less than 5%. So I think that 2022 figure might be, the income might be slightly low. That's why I'm okay with it.
All
Yeah,
right,
I'm okay with that.
all right,
That's good.
either way,
All right.
it's not that big of a adjustment.
Yeah, unless you're paying.
Well,
I
I
mean, it
don't mean to
actually
be,
is.
throw that out.
It's $2 million.
Yeah.
It's hypothetical.
I mean, it's balancing between the two. is all I'm
Yeah.
saying.
So you want to make a
Sorry.
motion?
All right, make a motion that we confirm the assessment. Excuse me, turn page. We confirm the county's assessment of $126,309,300.
Second, all in favor?
Aye.
Opposed, me, so that is 5 to 1. And my opposition is only because I think the expenses should have been adjusted.
Yeah, I agree. Sure.
The assessment is confirmed at 126,309,300. Thank you, gentlemen.
Thank you, Blake.
Thank you.
Grant?
Morning.
Okay, the last case on the agenda is RPC 16018-146, 1121 19th Street. Unoni, you can start with your 8 minutes and tell us about this property, sir.
Thank you. Good morning, everybody. My name is Armin Unoni. I'm a representative for the owner with Ryan LLC. The subject property today is 1121 19th Street North, specifically the hotel portion of the property. It's a 31-story property in Roslyn, and the hotel is occupying up to the 15th floor, while the upper levels are luxury condos. The 2023 proposed assessment is $42,706,300, and our indicated and requested assessment is $31,436,000. Flipping everybody, starting on page 41 of the BOE memo. We just have a couple notes here. Again, the subject property is a full-service hotel known as Le Méridien in Arlington. It was built in 2007 and it features 154 keys. The big issue this year is that the assessment increased by 63% or $16.4 million year over year. We believe this is excessive and definitely not supported by current performance. Just for reference, our requested assessment we believe is very reasonable and still represents a 20% increase year over year. Flipping to page 42 of the BOE memo, this is where we have our income analysis and the historical financials summarized off to the right. As you can see, in 2022, which is the third column, there was a significant improvement in performance. However, the revenue is still roughly 16.5% below 2019. And more importantly, as a result of increased expenses, the NOI is 25% below pre-COVID levels, which we believe to be, quite significant. Shifting to the far left column, the county column, we would like to point out, a few things. First input that we are requesting adjustment to is the other income. The county is using other income for food and beverage of about 1.8 million, and then other income or miscellaneous income of about 700,000. We believe that this is inflated compared to the actual 2022 figures, which were 1.2 million and about 460,000 respectively. The county is currently projecting roughly a 50% increase in both of these categories year over year, which we don't believe is supported. And we also think that it's worth noting that, looking at the 2021 figures, which I believe is what the county was working off of, when deriving these figures, it's an even bigger difference. So we believe that is, that really caught our attention, and we did not believe it was appropriate to forecast such a large increase. We did feel that the room revenue was fair. It's very close to the 2019 levels and probably a likely, outcome of what we'll see in 2023. So as a result, our total revenue is 10.9 million versus the county's 11.7. So, not a huge difference, but definitely significant when you actually look at the other income from 2022. The second issue is total expenses before reserves. Currently, the county is using 64.5% for total expenses, which at face value, it looks like that's coming from the 2019 performance. In 2019, the actual expenses were 64.3%. So we feel that this is very low. And it's also worth noting that the county guidelines, which are on the following page, warrants a 68.2% expense ratio for full service hotels. And additionally, the actual 2022 expense ratio was 67% of EGI before reserves. So both of these data points, are pointing to a much higher expense ratio than what the county is using at 64.5%. We do not believe that is a, justified input, and we believe at the very least, and what we're using for our requested assessment is 67%. We believe that to be a reasonable ask based on what was achieved in 2022. Additionally, the next issue becomes reserves. The county originally was using 3.1% of EGI for reserves on FF&E. This again appears to be coming from the 2019 column, as they reported 3.1% in 2019. However, in 2022, they did report 3.6%. However, what we're using the guidelines market rate of 4.5% for luxury full service hotels. We believe this is an appropriate market input. And that brings us to our NOI of 3.1 million versus the county's NOI of 3.8 million. It's also worth noting that this was revised by the county, I believe, in the recommendation. They made an update to the reserves based on the actual 2022 data and updated it to 3.6%. We found this to be kind of interesting because the expense ratio was not also adjusted to reflect that actuals, and we're not quite sure why. But again, so that's where we get our NOIs from. Additionally, we've adjusted the cap rate from 7.35% to 8.2% based on the RERC Washington, D.C. first tier investment properties, which you can see on page 446, the actual survey for that. Then we deduct the same personal property value as the county, and that brings us to our requested assessment of $31,436,000, which we do feel to be a reasonable ask, considering this is still a 20% increase year over year. And again, 2022 assessment here was $26.3 million. This year, the proposed assessment is $42.7 million, which is actually a $100,000 per key increase, $170,000 a key to $277 a key. This is, kind of staggering, to be frank, and especially considering the actual 2022 performance, we believe that there needs to be an adjustment. And just for reference, if we were to capitalize the 2022 NOI at the county's cap rate, the indicated value would be $34.5 million. So again, still far below, what the county is indicating in their approach. And again, the guidelines that I've referenced are on page 4, just to reference the fact that, there's 2 very strong data points here. 1, the county's own market inputs, and then 2, the actual performance from 2022, which we believe is the highest quality of evidence to be, that's being presented today. So we believe that it's, necessary to update that expense ratio as we've discussed, previously. Expenses have gone up significantly since 2019, and to be applying that expense ratio for 2023 and beyond, we believe is unreasonable. And so again, that's why we are requesting a revised value of about $31,436,000, which we believe to be a very reasonable ask, and still again represents a 20% increase year over year. We're not trying to say that the hotels aren't improving. We're acknowledging that in our analysis for sure. Our goal here is just to represent the actual performance of the property, and as well as the county's market data that's been supplied to the taxpayer as best as possible, while still capturing that, significant improvement in performance. And with that, I will turn it over to Chris. Thank you.
Okay, thank you. Mr. Chikas for the county, please.
Yes, ma'am. So again, we've talked about these, I think more than any of the property types so far this year. It's really just an agreement to disagree. We believe, based on the 2020 operating year, that it actually shows exactly what we're pointing to in our original assessment, which is return to normalcy. Again, RevPAR up 93%, average daily rate up 56%, within essentially a dollar of what was achieved in its historic 2019 year. Occupancy at 76%, 77%, within 6% of what was achieved in 2019. That's up 24%. Again, room revenues up 93%. Other food and beverage up 99%, essentially 100%. Other revenue up 64%. Total revenue up 93%. NOI up 224%. Again, outpacing what has been done at all other properties in the county as far as the economic indicators, averages. And I did myself a real disservice in poorly explaining some of the economic indicators. And again, these are on page 21 of 90. The air transportation that's listed there is for 1 month. The national airport actually broke all of its records as far as destination points for travelers coming through national at 27 million passengers. That broke 2019's record. So again, while you see on page 19 a listing of 2.2 million passengers coming through, again, an increase of 400-some thousand, that's 1 month. That's the month of November. So it only sort of escalates our argument that all of these people coming through national are in fact staying in the hotels around the area. Does it make more sense that they're going from National Airport past all these airport hotels to hotels in DC? I would argue not. I think the economic indicators argue against that. When we're looking at the value of the property, we actually for once agree with the appellant in the sense that it does seem like a 20% increase year over year is reasonable, but only when you start with the idea that last year's value was extremely low, less than 50% of the value achieved in 2019. So again, I think that what that really points to is that the county saw the downfall in hotel tourism in 2020 and 2021. We adjusted the cap rates, as we talked about, 50 basis points up. We made huge adjustments below the line for the first 2 years of the pandemic. We're well beyond that now. There is no more pandemic. It's not even being registered by the federal government. There is, beyond COVID fatigue, there's no more COVID. Air travel's up, inflation's down. We keep hearing inflation's up. As of January 1st, I wish we could talk about this year, but even as of January 1st, inflation was down 4 months in a row. So it's trending down as a direct reflect of the cap rates that we talk about, or I'm sorry, the monetary Fed moving up. That's the exact inverse relationship. As they move those interest rates up, the inflation moves down. That was what it was designed to do. When we see that people's savings rates expanded during COVID and pandemic, there's COVID fatigue. You're talking about people wanting to travel. We can see that people are in fact traveling in a big way. Let's talk about Le Méridien itself. It's an upper upscale brand. It's associated with similar to a Ritz-Carlton type of brand, European flair. You can see that it's achieving, again, $206 average daily rate, well above most of the competitors in the area. And again, this is a fairly isolated property. This is up in the Roslyn area, sort of just adjacent to the bridge. So these are people who are going out of their way to this property. And again, they're doing it at a 76% occupancy rate, vastly achieving what was achieved in its historic year of 2019. When we look at the adjustments made, again, as noted, it's based on historical information. So we heard last week, especially moving back and forth between request to use guidelines, request to use historical. So as we've explained, and probably not the best job of doing it, the guidelines are made up of reportings from the operators that send us these INEs. So when we're looking at the property itself, it tends to make more sense to look at the actual property historical operating performance rather than switch back to guidelines. When we're looking at the actual performance, we can see, again, growth, growth, growth. There's disagreement as far as that we're at 2019 levels. We're not. We're with, I believe, 8% or so lower than what was achieved in 2019. Again, signifying the growth that we've seen at 224% year over year NOI growth, but not yet achieving 2019 levels. So again, we believe we've made the argument successfully that there would be a 3-year recovery. We're in the 3rd year. We're still not at 2019 levels. We've shown you the economic indicators. We've talked about passenger levels increase at historic levels through National Airport. We know these are upscale brands. There's not much buy-in to the idea of these portfolio sales, but as you can note in the comment field, this property is included with 24 others sold for $3.8 billion, which gave an allocated sale price of $79 million. Even if you were to poo-poo that price and say, I don't believe it, look back to the last sale that was achieved at $54 million, still well above what's been achieved at the property, projected at the property. So in regards to why we switched from the 3.1 to 3.6 is a bit of a house cleaning issue whereby the bid rate that's adjusted to the cap rate, if we were to fully go out to the thousandths place, it actually would call for an increase. We don't call for increases to the original, so we did in fact apply the owner incurred FF&E of 3.6%, which we do as well. It's typical. If we apply a guideline FF&E and then the owner's actual comes in higher, we do in fact switch to that amount. So that led to the revision at $42,033,000. We would ask the board to confirm that revision based on everything we've talked about. Thank you.
Thank you both. Questions from board members? Any final comments, Mr.?
No, thank you, ma'am.
Tony, do you have anything else that you want to?
Sure. Yeah, just a comment, there is some compelling percentage figures presented by the county. I would just like to assert, the question from what. As we know, 2021 and 2020 were both devastating years for the hospitality industry and this property in particular. And I would agree that the pandemic is over. And I think what we're seeing in 2022 is representative of the new normal. Slightly less earning power, a lot higher operating expenses at these properties to maintain that. And that's why, especially the expense ratio in this case, we believe should be adjusted. We do appreciate that the reserves were adjusted based on actuals, but again, it's just not clear to us why the expense ratio was not adjusted as well. And I do believe that there was no commentary on the other income, which we think is still a significant issue. And that's all. Thank you.
Thank you both. Okay, so someone on the board.
I had 2 tweaks in mind. One is the guidelines for FF&E. These are tweaks. We don't have a I agree with what Chris said. We look at a long range, and if it's not the same as guideline, then we'll go up or down. But we don't have a long range. We got one from pre-pandemic and one from last year. I'd really like to go with the guidelines, and I have done the math on that. I was also looking at the operating expenses. I think they should be tweaked up too a little bit for all the reasons that we talked about in the last case. And I have not done the math on that, but I would think, 65%, for instance, 65.5% maybe, ought to be the right number. What do you all think?
Yeah, I agree. And I was listening to the comments about the inflation and all, but I do know that labor's gone up, and I do know that materials have gone up, so I agree with you on that, Ken.
And we're also presuming that there 11.5% growth in revenue, rent revenue, whatever it's called, per room night, is a healthy increase. Well, we ought to have a healthy increase, not one for one, but it ought to be reflected in the operating expenses.
Yeah, I mean, I thought there was a huge jump from 22 to 23, which is a little bit of a red flag for me. And so I was actually using the appellant's pro forma with the county's cap rate, up with a 34,711,400, which is still a 32% increase year over year.
Same thing.
Yeah.
Yeah.
Well, the only thing I was looking at is, like Ken mentioned at the beginning, which is the FF&E, that even at 4.5%, which is the guideline, I think it brings up higher than what they actually are. But I'm not uncomfortable with that number, to be honest.
Just FYI, that would make the bottom line 41,505,200.
With a different number using the 4.5%.
Did you do anything to expenses?
I didn't either, but I would support that as well. What would you get then for 4.5%?
After personal property, it's 40,802,000.
Maybe I deducted. Yeah.
You take
I'll do it again.
you do 4.5% of the total revenue.
So what was your
Sure
NOI?
did. Sure did.
What was your NOI?
NOI 3,635,577.
Right, I like that, but I think we need to look at expenses.
As well.
Yeah.
Yeah. Sorry. Does anybody agree, disagree with looking at expenses again a little bit?
Yeah, no, I think you got agreement. Greg, you want to-
I missed the NOI number that you used.
3,635,577.
But that doesn't have any expenses taken off.
Yeah.
Okay, let's keep that number and then look at expenses.
Yeah.
You mentioned your 65.5%.
Yeah, that just seemed a reasonable increase. That we've certainly seen increases larger than that.
Well, and you're going back, you go back to to 19. Because I was comparing 2019 to these numbers.
And they're at 67 on expenses. In past years, they're 82.
Well, that's because it's.
Yeah, that did come.
Yeah, that's
You only
right.
look- That's why
You're right.
19's the only
Yeah,
thing that
fixed costs,
matters.
they just had to pay.
Yeah,
19,
that's right.
19 plus another point or so. Yeah, 2019 expenses was 64.3. Times
Yeah.
have changed. That's why I think that's where that adjustment comes in.
That's why you like 65.5.
Yeah.
I would certainly.
So what was your 4.5%?
FF&E 527,745.
Yeah, that's what I got. I think I deducted it from the wrong number.
Well, then I
And you consider expenses as well?
That high enough, you think?
Just do it piece by piece,
Yeah.
but this whole, well, this one's up a lot. I think we should, again, I'm looking at it because the bump up in
39, 435.
more keys being used.
Say that again.
Because Jose's number with the FF&E, or the reserves at 4.5%, took his NOI and then adjusted to census up 5.5%.
You're
And I
over
got
column.
39, 435 after the personal property deduction.
Might be a good compromise. I think it should be a little lower, but I don't know that the rest are ready to go there.
So the operating expenses at 65.5%.
65.5% of that.
What's the dollar amount?
The what?
The dollar amount, it's no longer 7.5 million. Are you off of,
Column.
yeah, good. So,
All of that.
good. So what is it, 8, just about 8?
The expenses?
Yeah, just the dollar amount.
Yeah. It's 7,081.
Okay, so can you move that,
Absolutely.
Mr. Penrose?
That's where I was.
What number did he come up with? I'm sorry, 39?
39, 435, 400.
Yeah.
Okay, I'll make a motion to reduce to 39, 435, 400. We increase the FF&E reserves to operating expenses to 5.5%.
Okay, do I have a second?
Second.
A motion and a second by Mr. Metzger, all in favor?
Aye.
Opposed? Okay, it's unanimous. The assessment's reduced to 39,435,400 based on using column F, increase in the FF&E to 4.5% and increase in the expenses to 65.5%. Thank you, everybody. That completes the agenda. Any other business? Or
Madam Chairman, let me ask you a question.
business?
This is for next week. And one of the cases is Westover. And I don't know, maybe 8 years ago, I did legal work for the owners. And last year, there was a question, should a lot be part of the economic unit? So I gave some of the information from my old file to the applicant's representative. And so I guess I wanted to ask the county. I was going to ask him today, and I don't see he's still there.
Derek is on there.
Oh, Derek is on there. I was going to
Yes,
ask
sir.
the county and applicant, because I think Eileen's on, if they object to my participation next week on the Westover market case, because I'll spend a lot of time on it, and if they object, then I won't.
Because you have deep background.
Yeah.
I mean, up front, I don't. I'd like to probably talk to the team about that to get some history on the case. From what I understand, the parcel in question was included with the economic unit this year.
Yeah,
So,
based on what I shared.
yeah, and we didn't have any issue in doing that this year. So, from what I understand, up front, if there is any objection following this meeting, I'll send that to Mary, the chair herself.
Okay,
Okay.
Mr.
But
Orman?
I don't foresee there being one.
Yeah, the taxpayer's attorney does not have any objection to Mr. Lawson participating. And in fact, we have reached out to Ms. Roskind about having the county do an own motion adjustment to prior years to correct for the error. So we're waiting to hear from that.
If you object to him or not, I don't need to know what else you're doing. I was like, nice try, but yep. Okay, so no objection.
Okay.
Mr. Lawson.
Unless I hear from
Smiley
Derek.
face next week.
Thanks.
Okay, we stand adjourned here at 10:25. We'll reconvene next Wednesday, the 26th at 9 a.m.
Great.
Thanks, everybody.
Thank you.
That's the one that's got the.
I'm sorry?